what's happened, the entire financial services industry has been captured by a handful of big firms, and they have just shoved so much propaganda and regulation down people's throats that they believe, and to some extent it's true, they only have limited options, and that if anything doesn't conform to the propaganda, then it's risky. And most people don't have the ability to think beyond the indoctrination.
So who do you think that all that regulation is really protecting?
The regulation is not written by people who are concerned about the public. The regulation is written by the industry leaders to stifle competition. See, this is a legal argument that it's pretty basic, but it's ignored. If property rights were enforced, you really wouldn't need the regulation. For example, if a corporation is polluting a river and I drink poisoned water, I sue the corporation out of existence. But you're not allowed to do that. The corporation has to pay a fine to the government for violating a regulation. We have this really grotesque regulatory framework that operates under the executive branch, BC, the alphabet agencies that were really established under Roosevelt. And what they do is they allow for the biggest private interests, the biggest corporations, to write the rules, push them through the lobby, and to get them adopted is either regulation or even law in statute in many cases. And the motivation there, it's people aren't that smart, so they can't catch on. Oh, why would a big corporation put rules that limit what they can do? Because the limitations on themselves are negligible. Oh, they've got to spend an extra $1 million on a lawyer to get through a hoop. If they go under, the government bails them out. Doesn't matter to Goldman Sachs. But if you're another startup firm, that $1 million keeps you out of the industry, right? So the regulation is there to protect the established corporations from competition. I think many people ponder, why is it that corporations make so many bad decisions with respect to the longevity of their company, the corporation? And the answer is they are making decisions that are aligned with their incentives. What does that mean? It means that a big part of their compensation is typically stock options. So they are motivated to pump the stock value as high as possible, and they are incentivized to retire and sell those options when the stock values have reached their peak. So the typical approach is a new CEO comes in during relatively bad times for the company, and they do a bunch of things to increase the stock price. When they feel it's at a maximum, they've done all they can. They're reaching the end of the peak. They'll retire, they'll exit. The value of the corporation will fall. A new group of executives come in. They say, look at all the problems of the last firm. We're going to fix it. And the whole cycle rinses and repeats. Hank Paulson, very quickly, he played the game as a CEO as well as it can be played. He was the CEO of Goldman Sachs until 2006. And that's when you had the run up in the economy driven by the housing bubble. He saw the writing on the wall in 2006, and he left the role of CEO at Goldman Sachs to become Secretary of the Treasury. And everybody asked, why would you leave such a role to take a government job that's going to pay a couple $100,000 a year at best? Like, why would you do such a thing? The answer is this. He knew that we were reaching the peak of the economy. And so when you become a public servant, if you work in politics, particularly in this case as Secretary of the Treasury, you were forced to sell off your private interests that create conflicts. And so he was forced to sell off his stock positions in Goldman Sachs at the peak of the market. Okay, fine. What else? In doing so, he was able to mitigate the capital gains tax he would otherwise have to pay as an ordinary citizen by virtue of becoming a member of the cabinet. And so he sold off millions and millions of dollars in stock, effectively tax-free, So yeah, he only made a couple $100,000 for during his term as Secretary of the Treasury, but in doing so, he saved himself tens of millions of dollars, if not more, in capital gain tax liability. Great example of pumping up a firm, Goldman Sachs, exiting close to the peak in an almost tax-free way, working for the government, again, creating policies that bailed out Goldman Sachs indirectly through the bailout of AIG. So the government bailed out AIG so AIG could pay the insurance claims that Goldman Sachs had. So they were paid indirectly. This is one example of many of the different plays how private interests utilize government to leverage their personal interests and the interest of their colleagues, say Goldman or otherwise.
The majority of people that are somewhat involved on C-suite level, lots of those guys are also just really good guys. It's not that everybody just plays this Goldman game. It's never the people, it's the system that rewards the wrong behavior. Like the idea with the stock options is obviously that it should reward the best behavior that helps the company in the long run. But then it can be used in a way that is not that beneficial.
So I can certainly appreciate how someone is the CEO of a company, how they would want to be vested in their own company. They should be. It's hard to incentivize long-term decisions because long-term decisions require investment that don't necessarily always show up in the financial statements.
I think that's a good final statement.
Indeed. Good to see
All
you,
right.
Dan.
Yeah, thank you guys.